Purchasing power parity is a measurement of prices in different countries that uses the prices of specific goods to compare the absolute purchasing power of the country's currencies. The Big Mac Index is a survey done by The Economist that inspects the relative over or undervaluation of currencies based on the relative price of a Big Mac across the world, and is an excellent illustration of purchasing power parity. Let's look at the Big Mac purchasing power parity exchange rate between two countries. We divide the cost of a Big Mac in one country in its own currency by the cost of a Big Mac in another country in its own currency. This value is then compared with the current exchange rate. In July 2020 in the United States, a Big Mac cost $5.71, while here in South Africa, its price was 31 Rand. The implied purchasing power parity is calculated as follows. If the parity value is lower than the actual exchange rate, then the first currency is undervalued compared to the second currency. In our example, the South African Rand is 67% undervalued. This represents our currency's lowest position on the Big Mac Index for over 20 years. Whether a currency is over or undervalued, it has an impact on a country's foreign direct investment as well as its imports and exports, commonly referred to as its terms of trade. This has a large impact on a country's economic growth. As an investor, it is often unsettling to observe currency volatility, but it is important to remember to not be swayed by short-term currency movements, but rather trust in the ability of your financial manager to construct an appropriately diversified long-term portfolio.